tools to provide much needed support during the pandemic. The BSP kept rates unchanged in August following 175 basis points of reduction earlier this year. This brought the main policy rate to a record low of 2.25%. Only Capital Economics forecasts a rate cut by 25 bips to 2% on Thursday and another 25 bips to 1.75% by year end due to what it describes as weakness in recovery. So Dan, we reported that the government is looking at multiple sources of debt to plug in its budget deficit, but it seems our latest balance of payments print is actually in a surplus. Tell us more about that.
Exactly, Jess. So there are two things to be looking out for here, right? Our internal deficit and our external, so to speak, surplus right now. So as you mentioned, our revenues internally not necessarily enough to plug in that deficit in terms of our budget. But if you take a look at your screens here, you're going to be seeing our August balance of payments is still at a surplus. That's at $657 million. So meaning we're actually receiving more money then we are paying for certain things offshore. A lot of this, of course, according to some analysts, have been due to the fact that our imports of oil have been much lower. Crude oil is also at a very low price compared to a couple of years ago. Now, just to mention that the year-to-date surplus now stands at $4.77 billion. That's versus $5.5 billion a year ago. And our August VOP compares with a $493 million surplus. So a little bit lower than what we've seen this print. So 1 year ago was actually still a surplus, but still lower than this print. Now let's take a quick peek at how our local currency has been doing this morning. We are actually strengthening a touch. You can see on my screen here, 48.435 to the greenback. That's as crude oil, however, is actually going back up to $40 a barrel level. Recall that we had seen it sliding last week to around 38. So again, our peso strengthening a touch. It's open with some markets here, especially on the offshore front. You can see a nice recovery here staged over in the US. The Dow Jones up by 1 3/10%. The benchmark S&P 500 as well. And the NASDAQ, take a look at that, up by 2 3/10%. Now, it's a very mixed picture here. Last week was very, very volatile, but there's going to be a lot of things that investors are watching out for offshore this week. So on Tuesday, you're actually going to be seeing the first US presidential debate. That's going to be between President Donald Trump and Democratic opponent Joe Biden. There's also going to be a September U.S. employment report on Friday. That's going to be the last before the November U.S. election. Now, over in Europe, you can see a bit of a mixed picture as of Friday's last closing trade. There is going to be a final scheduled round of talks between the UK and the EU on a post-Brexit trade deal. That takes place today, Monday, and this has been pushed on further and further, has been delayed because of the coronavirus outbreak. Meanwhile, global equities are actually on course for the first month of losses since the month of March. We had been on the rallying front, and this September seems to have been the month of a pullback. Investors still weighing further signs of recovery in China against more virus outbreaks in some part of the world. The bright spot here, data over the weekend showed China industrial companies actually grew for a fourth consecutive month in the month of August when you take a look at their bottom line. Take a quick peek at Asia. Everyone seems to be opening with gains here, with Japan's Nikkei 225 up by 0.7%. Hang Seng over in Hong Kong as well, enjoying those gains. And China, I had mentioned some optimism over the weekend spilling over into their markets. Let's take a quick peek at how our own local bourse is faring compared to those gains we were seeing over in Asia. Not a bad start. We're up by 0.2%, so a bit softer than what we've seen for the region, but still at least on the front foot. So that's at 5848 spot 22. Recall that we had closed down a touch on Friday that was down by 0.12%, but we were also lower by 1 and 2 tenths of a percent on a weekly basis. Last week was the second straight week of a decline, and this amid the fact that values of trading were really low. So the turnover slumped by 30%, just an average of 4.21 billion pesos per day exchanging hands. But the good news is that also net foreign selling was actually dropping. So that was down by 41% yesterday. But again, according to several analysts, a lot of last week's activity was really because of these international events happening. Now, even as we are at a 3-week low, the good news is we are still the highest in 6 months. So this is our March low here, that crater in my chart, and we're still higher than that. Than we've seen, at least in that low, or when we had hit bear market territory. A lot of things coming out this week. What is going to be happening, especially in the capital, when it comes when it comes to what's going to happen to the restrictions? Are we going to still be in a GCQ? Are we going to be in an MECQ again? So a lot of questions on that. You've also got a cautious sentiment continuing to pull the PSEI down. That's according to AAA Equities' Chris Mangon. So there's going to be a heavy econ trading week. Another thing, the central bank makes a policy decision this week, so that's a lot to be watching out for. Let's take a quick peek at some sectors here and who are the bright spots pulling us up this Monday morning. Fresh trade, take a look at that. All across the board, gains. So even if these gains are not necessarily strong or not necessarily all double digit, at least we are all seeing a broad-based recovery here. Financials leading the pack, that's up by 0.6%. I just want to take a quick peek at properties, which have not rallied together with the other sectors this morning. This as property stocks had already gained on Friday. That's amid the home prices that had been gained. So the property index has been one of the worst sold off. I'm just going to be pulling that out for you here so you can see the year-to-date performance of the property sector. That has halted a 3-day slump after the central bank said that residential prices rose faster in the second quarter. So that's very interesting. So a gauge of the nation's biggest real estate companies had actually moved on the back of that. That was up by 1.8% on Friday. And this as the residential real estate price index rose, get this, 10.7% quarter on quarter in the second quarter. So it's actually a reversal from what we had seen as a contraction 1 year ago. The second quarter index rose 27.1% year on year, highest since the start of the series in 2016. So very interestingly here, people are buying residential properties amid the pandemic. There was a higher demand for high-end projects that drove the average price per square meter upwards. So it's very, very interesting when you talk about residential real estate loans, Jess. So a lot of very interesting things happening here.
All right, very interesting. A good take up, at least in the second quarter, for the property space. But a lot of the other things to consider here. You have the government deciding on mobility restrictions. What's the status of all those airport modernization plans and the travel outlook? How's it looking so far, Dan?
Okay, Jess. So for a while, there have just been, a halting in construction, right? Especially when you talk about airports, nobody knows when all these travel restrictions will be lifted. But now it seems that the proponents of the airports are back on track. So at least they're hoping to get back on track. They have revised, however, their unsolicited offers. So it's not going to be the same as what was previously offered before the pandemic. And this is according to Transport Undersecretary Reynoso. There will be proposals with revised economic and financial models. They are going to be currently under evaluation. However, the good news is just no one has pulled out so far when it comes to the unsolicited bid. So recall, which ones are these? You've got Aboitiz InfraCap. They had submitted unsolicited offers for Bohol, Panglao, and Lagundingan in Misamis and Bicol. You've also got Chelsea. I'll pull that out for you. This is, of course, Dennis Oy. And together with Chelsea, you've also got his Udena Corporation. They are still going to be submitting that proposal, unsolicited proposal revised for the Davao Airport there, and also Bacolod Silay. You've also got the Villar Group with their Prime Asset Ventures, which had submitted an offer for Puerto Princesa and Iloilo International Airport. You can see Chelsea Logistics here trading up by 6.2% to 4 pesos and 13 centavos. Now, another one that is super optimistic despite this pandemic is Megawide. Now, Megawide, recall, has not yet completely received the bid for the NAIA airport. This was given first to a consortium of 7 of our largest conglomerates, and then they received it after those 7 had actually pulled out. And they want to jumpstart those NAIA modernization plans. They said they're ready. It's going to be a $2 billion modernization plan. And get this, Jess, they say it's actually the best time to be developing or redeveloping NAIA while the foot traffic is really, really low. So they can actually do a lot of work right now. Under its plan, they want to expand the airports without necessarily expanding the capacity of the runway. So they're still actually waiting. They have the OPS, but they're still waiting for the go signal. Meanwhile, I just want to share that there's also another group, which is the Italian Thai group. They've just been awarded to take part in the PNR Clark Phase 2 project, which also Megawide is a part of. So that is a contract to build a 12-kilometer elevated viaduct and 1 train station in Pampanga. So that is basically going to connect, Clark Malolos all the way to Laguna here. So that's very interesting. That's also going to be a very easy way for us to have access to the Clark Airport and also to NAIA. So a lot of interesting things going on. Megawide, however, down by 3.6%, bucking the gains of the local index this morning, trading at 7 pesos and 16 centavos. So more on markets later on the broadcast. We've actually got Mike Enriquez of Sun Life Financial. Now, meanwhile, Jess, let's move over from equities into regulation, let's say, of banks. You've got all of these issues here, the FinCEN leaks, for example, threatening the stability of our banking system. And the SEC wants to implement further stringencies or restrictions when it comes to money laundering and terrorist financing. Tell us more.
All right, definitely. So basically, this time around, they really want to ramp up at least their assessment system of not just banks, but other financial services here to make sure at least that we don't get included in the gray list come 2021. So in a nutshell, they want to be more proactive via a new rating system. So basically what they're going to do is they will measure the efficacy of firms in preventing money laundering and terrorist financing. So recall that back in May, you have AMLAC saying that they are expecting remittances to drop, or at least may drop by 2 to 4%. If such activities are not controlled, as international banks may actually be wary or at least cautious of transacting with Filipinos. And like what you mentioned, there are other points of concern here, like the FinCEN files, finding out, you have 27 suspicious activity reports linked to Filipino individuals and firms as probable originators or beneficiaries of multi-million dollars worth of suspicious wires. So let's take a look at this new risk rating system that the SEC is going to implement. So basically, it comes in 4 levels. So firms will be rated either weak, needs improvement, satisfactory, or strong. So what are the factors that they are going to look at? They are going to check if the company's oversight is efficient. So that includes at least policy direction from their directors, senior management, and other executive level staff. At the same time, they're going to check as well anti-money laundering policies of the firms, their internal control and audit system, and as well as the implementation of these policies. Now, the company's risk profile will also be probed. So that includes the size of the firm's assets, how complex are they, how diverse are the products that they offer. At the same time, a general profile of their customers as well. And they will also look into the company's engagement in international transactions, the distribution channels used, and their compliance to relevant rules by the SEC. So question is, who are covered by the new risk assessment? So basically, this will include banks, non-banks, you have quasi-banks as well, trusts, insurance companies, securities dealers, mutual funds, forex, and the likes who provide other financial services. Basically, those are required to do money laundering risk assessment under AMLAC.
Okay, Jess, so if they are rated weak or needs improvement, what's really going to happen here? Are they going to have to pay fines? Do they have a timeline to improve? What's the deal?
Okay, not immediately. Basically, since after all, this system is for assessment and evaluation purposes, intended to enforce actions to lessen the risk. So fines will not be right away slapped, at least on those firms that are rated weak or needs improvement. For those, of course, who will be rated satisfactory or strong, definitely there will be no interventions that would be needed. Now, however, for those who would be rated as weak or needs improvement, they have to submit a written action plan to the SEC and be continuously monitored. Now, if after that process they still fail the risk management process or assessment, then that's when they'll be penalized, and quite some hefty fines here. Then fines may actually reach from 5,000 to 2 million pesos per day of violation. That may also lead to a permanent cease and desist order, a revocation of their certificate of incorporation, and a dissolution of the corporation, and a forfeiture of their assets. So all these will take effect 15 days after its publication on the SEC website and to national newspapers. Again, the hope is that, of course, the Philippines still is under observation until February 2021 to address gaps in money laundering and terror financing rules. So the hope basically here with this new set of rules is to avoid inclusion in the gray list come 2021. Now, here are other headlines we're keeping our eyes on. The Finance Department is keen on keeping the country's budget deficit at bay while keeping interest rates attractive for investments. Balance of payments swung to a 4.4 billion peso surplus in the first half, pushing the domestic economy back to a net lender status. That's according to the DOF. Conducive interest rates, inflation within the 2 to 4% target band, and a competitive valuation for the peso are also seen as other factors that would help fuel economic recovery. The department's position isn't meant to conserve resources in the event of a prolonged pandemic. The strategy also includes tapping the country's strong credit rating and keeping stimulus spending manageable. However, London-based think tank Capital Economics warned that lackluster fiscal support could mean weak economic recovery for the country. The think tank said slow government response has done lasting damage to the economy in the form of high unemployment rate and increased bankruptcies. This is the same poor response, they said, that's putting pressure on the central bank to act more than it should. The Banco Central has already slashed benchmark rates by a total of 175 basis points this year. Capital Economics thinks a 25 basis point cut is due this Thursday at the BSP policy meeting. Now, the government borrowings ballooned to nearly 2.5 trillion pesos in August amid the DOF policy to keep fiscal deficits manageable. The Bureau of Treasury said this followed the record high retail bond sale in the same month. Data from the Treasury showed gross state borrowings reaching 2.47 trillion pesos from January to August. This is now equivalent to more than 80% of the country's 3 trillion peso borrowing program for the year. The Philippine Star reports that in August alone, government debt surged by 700% to 612 billion pesos, up from just 76 billion pesos in the same month last year. This is due to the recent issuance of government's 5-year retail treasury bonds to the domestic market, which fetched over 500 billion pesos, which is the highest amount recorded so far. External borrowings for the first 8 months of the year climbed by 85% to 509 billion pesos year on year, more than half of which came from program loans of multilateral establishments.
And this from the Philippine Star. They're reporting that the central bank is expecting more companies to lay off workers during the fourth quarter. This is as more firms are putting off expansion plans for the rest of the year and in 2021. That's amid the restrictions caused by the pandemic. You can see on your screens here, BSP said results of the third quarter business expectation survey showed employment outlook plunging to the negative territory at negative 5.5% from 16.9% in the first quarter. Employment outlook for the next 12 months also took a deep dive to negative 2.1% from 30.8%. Now, in line with this, the Bangko Sentral also saw a decline in firms with expansion plans for the next quarter and over the next 12 months. The BSP said the major risks to businesses continue to be insufficient demand and weak domestic competition brought by economic effects of the COVID-19 pandemic. The World Trade Organization, though, is still holding out hope for a slow economic recovery. That's as global services may have bottomed out in June. The WTO said its services trade barometer for June fell to a record low, raising the possibility of an early recovery. Now, although services trade is still seen to remain below trend for the second half of the year, the organization said recovery in passenger air transport could contribute to a powerful turnaround. Analysts seem to agree, however, that for the Philippines, recovery will be slow, citing a more urgent need to revive domestic business and economic activities. These last few days of September will be critical to markets as the government ponders immediate steps in its COVID-19 containment plan amid a flurry of economic data. Now, here to help us digest that situation, we have with us CIO of Sun Life Financial, Mike Enriquez. Good morning, sir, and welcome back.
Yeah, good morning, Danie.
Sir, let's kick off on your general economic sentiment. Basically, what are markets hoping to happen on October? Are they hoping, for an extension of the GCQ in Metro Manila? Are they pricing in downside risks that we might actually be reverting back? Or is there some upside optimism here going on?
I think for us, we are more on the optimistic side of things. Although there's still that clamor from Manila mayors, I think, to continue with the GCQ for an extended period of time. And we still haven't seen cases declining significantly as we speak. So definitely from where we are at the moment, we have seen the economy restarting, although on a slower pace than what we originally expected. We continue to be optimistic on there would come a point in time, maybe not October, but probably towards November, December, where we can lower the quarantine measures from by the government. So that can spur again additional opening up of the economy, lesser restrictions for mobility. Definitely, that would help a lot, and we really need that, as what you've mentioned in your report, that what's lacking at the moment is really fiscal stimulus from the government. We've seen a significant monetary stimulus over 6 months, and I think what is lacking right now is what the government would really need to step up and release a fiscal stimulus measure that's significant enough.
Okay. My question, why is this fiscal plan lacking? Is it because we don't have enough in our coffers? What is hindering the government from spending more? They don't want but to increase taxes. Is our debt levels already too high? We've already actually reached that record levels of debt. And as you mentioned, the BSP has been stepping in with liquidity already. So what's going on here, and what do you think could be done better on the fiscal front?
Well, for one, at least the 2021 budget has been passed already, and it's about 10% increase from the previous budget. So at least that is a positive view for 2021. But since the pandemic started, we haven't really seen the government step up after the social amelioration program. And I think we would really need a stimulus package from government, although it's quite difficult because under our laws, we could not just have a fiscal stimulus without a corresponding revenue increase. So
Mm-hmm.
that is where the struggle is at the moment. And uh, what I'm hearing is we have seen as well, at least the build, some of the major projects being supported not by the government, but also from conglomerates. I think there's a
Okay.
different tack now by government. Previously, they would want ODA, but now they're opening it up more for PPPs again. And I think that's
Mm-hmm.
a better way to partner again now with the private sector, as we all know that the government is quite limited now in budget. They've exceeded some of the the debt ceilings, at least for this year, since they had to fund COVID-19 related expenses, so they had to borrow more. But at the same time, they recognize the fact that we need, as a country, to continue with our major infrastructure projects. So I think it's high time now that they revisit again, partnering with the large conglomerates, which continue to be quite liquid because over the last few years, they really haven't invested significantly.
Okay, Mike, you already mentioned about monetary policy, and the BSP has been saying that they've stepped in enough. They might not cut rates any further. But now that you've mentioned that the fiscal side is still lacking, will markets appreciate a further rate cut, given that we're already going to be in negative interest rate territory if that happens? And how would that actually affect the economy? Is that a good thing to have negative interest rates prolonged?
Well, definitely not. That's why I think the BSP is really conscious of the fact that if they lower their policy rates again, that will be below inflation already. And that is not a good sign if we would move forward. I think the BSP is quite concerned on the fact that I think that number one is the transmission to the banks. Instead of the fact that we have seen a significant policy rate adjustment, we haven't really seen banks adjust interest rates for loans. And
Okay.
even if they adjust, will there be will they award loans to the ones who really need, not the big conglomerates, but the small medium enterprises? For the market, if the BSP decides to move this Thursday, definitely it's more in the signaling that the
Mm-hmm.
BSP will continue, and that will be taken as positive by the market. But then again, I think there's really not much additional effect, even if they cut rates by 25 basis points this Thursday, because there's still so much liquidity in the system.
Mm.
They
Okay.
are still buying bonds on a daily basis. We're
Mm-hmm.
doing our own QE. So that's an additional liquidity in the system at the moment. So given that, I think there should be more on the spending side now, not on lowering of rates.
And also in the lending side, that banks are not too risk averse, as you mentioned, to lend to the small companies and not just to the big
Correct.
conglomerate. Let's talk about fundraising, since you already mentioned it. I mean, there's been a flurry of big conglos tapping the bond
Mhm.
markets because nga interest rates are so low. But also, the equities have suffered on the back of that because the risk is
Mhm.
higher. Now they're trying to make it easier for companies to list. They're proposing, the stock exchange is proposing less stringent rules. Will this bode well for the markets? Will this actually be a good incentive, or will it increase the volatility and risk that we're already seeing now, and much more speculation that might be going on?
Yeah, you're correct to point out that we had seen a flurry over the last few months of borrowings from conglomerates, from corporates. But what we've noticed is those are just short term, and I think it's only replenishment of working capital. But what was quite significant was after the government launched the RTB. It's about 516 billion. I think that's the largest RTB on 5 years. We have seen now conglomerates looking to fund longer because they were quite wary during the start of the pandemic to borrow long term because they've cut back on all their capital spending. What they would need on the short term would just be liquidity and working capital needs. But after the RTB, and they saw that there's a huge demand for longer dated bonds or securities, then we've seen now Ayala Land, AEV, SM, IC going into the 5 years or longer. So definitely that's something positive. You can expect now that conglomerates and some of the corporates are starting to pre-fund their capital expenditures for next year. And talking about the market, how will this affect the equity market? Definitely, there's still a lot of liquidity in the system. Um, what is still not being discussed at the moment is the effect of low interest rates or prolonged low interest rates to some of those like pension funds, retirement funds, insurance companies such as us, which
Okay.
we could not fund long-term liabilities if interest rates will continue to stay at these low levels. So our view was that there should be more allocation onto riskier assets such as equities down the road for us to be able to meet some of those long-term obligations, and rightfully so, because I think it has been pointed out in several forums and every day that the Philippine equity market is really quite low, and
Mm.
that it offers a lot of value.
All
Okay,
right.
so still a lot more, we still want to be able to gain some money from the equities market and not just put all our assets in lower risk yield investments. Jess?
All right, Mike, Jess here. Let me just jump in very quickly here. What's your take here? How do you see things happening now in the telco space here? Especially, you now have, of course, the upcoming IPO of Converge.
Mhm.
At the same time, is now really going to be considered at least the fourth telco player here. So a lot of things happening, especially as well with Dito was a ceiling on that. At the same time,
Mhm.
you have AT&T already at least testing their 5G services. So what's your take here at the sector?
Okay, so I think we welcome the IPO of Converge. Number one, it's large. I think it's one of the largest over the last few years. Dito, I think it's still in the works. We haven't really seen any concrete moves of the company, although anecdotally we have been hearing development of sites in certain areas to test. But the incumbents, both Globe and PLDT, I think, in our view, are have reached mature levels already. And what we're quite excited about would be Converge because it's the first pure fiber and broadband play in the market. If you look at the regional peers, those that are in the pure fiber play command a higher EV/EBITDA multiple compared to the incumbents of Globe and PLDT. And it's the growing demand side of the telco industry, the fiber and broadband.
Okay, Mike, one last question, just broad here because we didn't really get to tackle and we don't have much time. But what do you expect for the equities market? I know it's very hard to give a long term call, but
Mhm.
in the short term, last week was really a sell off because of global markets and a lot of things going on there.
Mhm.
That seems to have been calming down. I mean, we saw Wall Street performing pretty well on Friday, Asian equities. Are you expecting that if those offshore issues are actually settled, we might actually be back on the track to breach the 6,000 levels again?
Well, at the moment, domestically, there's really no catalyst. So from where it is at the moment, I think the 5.7 to 6.1 range will we expect the PSEI to hover within that range. We need to see some catalyst. I think that the number one catalyst would be the number of COVID cases to
Still.
continuously
Okay.
decline. Second would be easing of the lockdown from GCQ. If it's gonna be MGCQ for the NCR, then that would probably be positive as the economy would be able to open up more. The third would be something that we're closely watching would be the road towards the US elections. Definitely that would make global markets quite volatile at the moment. Unfortunately, the US markets have rallied significantly, even the Philippines haven't, but if they correct, we also correct. So I think those are the things that we have to be wary about as we see in the next few months. But the best thing, if ever, for the market to really breach the 6,000 convincingly is if the
Mhm.
government would really have a strong fiscal program.
Okay. Thank you for those insights. Again, it all boils down to the fiscal plan and also whether this liquidity that has already been released by our monetary easing can actually penetrate the domestic economy amid all of these geopolitical issues offshore. Thank you so much for those insights, Mike Enriquez, CIO of Sun Life Financial.
Thank you.
And that's a first look into the business day. Today is Monday. I'm Danie Laurel.
Catch us again tomorrow at 10 in the morning. I'm Jess Delos Santos. We are One News.